Bias Trading here, and today we're going to be going over the 5 keys to backtesting. Now, this is the presentation I gave to around 126 traders on kind of getting introduction into backtesting and the kind of overall process, so I hope you find some value in it. Now, I started this presentation with a quote from Mark Douglas. He's the man who wrote Trading the Zone, which is a psychology/mindset book. Now, he states that edge is nothing more than an indication of a higher probability of one thing happening over another. Now, this is actually very true for higher win rate strategies. However, he should have included some idea of positive expected value, which also accommodates for lower win rate and higher ROS strategies. Now, key 1 and 2 are pretty basic, but I felt obliged to at least go over them because they are the foundations of what you need. So first is just screen time. So this is just going to be watching the market day in, day out, so you can uncover patterns and ideas that you actually want to dive deeper into. Most of the time, I'd say this has to be done for at least a year, but it can change per trader. Now, this will really help you have an understanding of the market. You'll learn a lot just observing the movements each day. And you can also accelerate this by purchasing things from mentors, for example. They can give you a lot of setup criteria or overall ideas that can speed up your experience. However, it's not always needed. You can do through Twitter or podcasts. Personally, now a lot of my knowledge just comes from podcasts now. I did purchase a lot of things more at the beginning. And I would say they would help me 50 to 60% of the time. However, podcasts are also a great resource. Lastly, it really helps build confidence. The more screen time you have, the more ignorance that you'll pay down, which will mean you're aware of more things than you were before. And it's very important for the market because there'll be a lot of repetitions and a lot of events you need to having contact with to really understand. 2 is define this idea. So whether this be an idea that you found yourself, so this is just a repetition in the market that you think potentially has edge, or if this is something provided from a mentor, for example. You want a scan, which could be through Trade Ideas or TradingView, for example, or you can do it through a basic checklist, like a notepad of just what has to happen for it to be a valid setup. Now, there's a lot of things you could be looking for here, but an overall example could be key patterns and signals using technical indicators, chart patterns, or maybe even news events if you want to go macro. Next, you want to clearly define the requirements for that valid setup. Make sure it's repeatable and measurable, otherwise it'll be quite hard to backtest later on. Now, I know every setup is going to have some layer of complexity, and that's totally fine, but try and keep it simple when creating your checklist. You overall want it to be simple so it's easy to understand, whether that be through to code or to identify the setup real time. Lastly is about clarity. You want your requirements to be quite rigid. You don't want them to be too loose, otherwise you're going to introduce noise into your setup. By loose, what I mean here is mainly introducing a lot of discretion or things that can't be quantified. And this is normally where you either have to leave those until the end of the setup where you may be manually executing with some discretion, or you are just breaking down the parts that you can understand and quantify. 3 is gathering sample data. So this is about 30 to 50 samples. This can either be done manually or through code. If you're going to do it manually, I'd normally recommend doing it through Excel or Google Sheets. If you're going to do it through code, we'll kind of get into that in a bit. But you want 30 to 50 samples of the setup requirements that have happened to your scan over the past maybe month, or this can be real time, so you're doing it at the end of every single day. Now, what data do you want to collect? I'd actually personally start with charts. Even someone like me that's more data driven, I find a lot of use in the charts for a simple reason. They are the representation of what happened that single day for that particular ticker, and that can teach you a lot and show you a lot of commonalities between those a lot quicker than it can through data sometimes. So that is why the charts are a great foundation. Next is the open, high, low, close, and volume values. They're very basic, and you can even do this through Google Finance, but they can come in handy every once in a while. Also, you want to include any relevant variables that is relevant to your setup. So this could be like gap percentage if you're doing a small cap gap setup. Now, it's very important you have high quality data for this stage. You want to make sure it's accurate and not mistyped. So if you're doing this manually, just be aware you're on a linear scale. The more time you spend data inputting, the more likely you'll make a mistake, which means you need to be going over your 30 to 50 samples at least once or twice. If you're doing this through code, just make sure you have a good data provider. So this could be Polygon, Alpaca, NBA Historical Data. All of those are great resources. Lastly is avoiding the noise. As with the scan, we want to keep things simple. No need to gather a ton of data at this stage. This is simply a pilot test. I would say max around 20 data points. So you don't need to include anything that's unnecessary, such as macro news if you're trading small caps. Now, the reason I call it a pilot test is we want to gauge here, is it worth your either time or money to get something fully backtested? There will always be an opportunity cost on pretty much any decision. And we're trying to understand here, does this setup have macro edge and does it have potential entries and exits? If so, then it can be worth to pursue this as a full backtest, 5 to 10 years of data. Now, for entries and exits, you want them to be specific, measurable, and achievable. By achievable, what I mean here is you need to account for slippage or potential no-fills. That's really going to depend on what setup you're trading. If it's a volatile setup, you'll really have to gauge this. I normally recommend recording, 3 to 4 examples of your setup being traded either live on like 1 or 2 shares, or on sim, and you can get some idea of how likely slippage is. Obviously, it's not always going to be the best method for this, and overall, you will need to have some awareness and common sense about how kind of likely it is for your setup, and that will really come down through time of experience of trading that market. But it's great to be at least aware of it at the beginning and not do a full backtest and then realize at the end when you start trading it live, it has so much slippage and it's actually not that profitable. Now, if you've got all 3 of those, it's going to be quantifiable, realistic, and easily identifiable. Next is the macro edge. So we're understanding here, does something have an overall trend or probability that one event occurs more frequently than another? So this could be a very simple example. If we're doing gap strategy, this could be a higher close red percentage for a short bias. Or we can do the second method of macro edge, which is just doing P&L simulations. So this is basically understanding something with a low win rate but high ROI on a certain data point, and then seeing if that is profitable over the long run as well. Normally those are done through Python. You can do some of them through Excel as well. Or lastly, you could really identify that through the charts themselves, as a lot of people are able to find those lower win rate but higher ROI setups through the charts. Now 5 is the backtest. So after we've established that there is some macro edge and there is potential entries and exits for this particular setup, we're going to go over what we actually need and how much data we need. So first is the look back period. So the amount of data, I would say, kind of depends on what you're trading. For small caps, I normally recommend about 3 to 5 years of data. For something like large caps, normally 5 to 10, normally because large caps has lower sample frequency, meaning you'll probably need a bit more data to actually understand it or get enough samples or tickers. And then for indexes, you could really go 10 years plus here. I've personally on my futures algos tested it on 10 years, but the significance has been more in the last 6 to 7 years. So really does depend on that, but you can build very robust strategies in futures or indexes because you have great access to a lot of data, plus the volatile changes between each year isn't as much as personally like small caps, which is a lot more cyclical. Now you also really want to be aware if you are limited to data, so if you only have data from 2020 or 2021, those are going to be outlying markets currently. Now, obviously, we hope those will repeat and we can get another really hot market, but currently, those are pretty unrealistic expectations and unrealistic statistics for people trading currently in 2023. The best way to combat this is just by having enough data. So if you have 5 years of data for OTCs, for example, you can get a great overview of seeing how it compares each year. Plus, you'll have, by the law of large numbers, very good median statistics over those years because you have samples from all of those different macro environments. This will give you a better understanding of the setup's long-term performance. And I'd also really recommend doing a simple entry and exit, such as maybe open and close, to help visualize the equity curves of the macro edge over time. This will allow you to inform your strategy. So what this will you'll be able to do is see what years were most profitable in macro edge, what years are the biggest drawdowns, and you'll be able to see any commonalities between those. Those commonalities could then be additional filters, or you can at least now be aware that your setup performs best in this A+ market environment, whether that be through hot or cold market environments. You'll also be able to now use the median percentage and other statistic data because you'll have way enough samples compared to your pilot test, which is only 30 to 50 samples. I keep on seeing a lot of traders relying on way too little samples. I'm sorry, but anything below really 100 samples isn't a great basis for statistical significance. So you really want to try and get above 300 most of the time. Nothing wrong with creating, I would say, a grading system. So maybe something with 100 samples is A++, but that doesn't fundamentally change your criteria or anything like that. Now, one example I wanted to show of how I use data on a daily basis. This is an Excel dashboard. This is kind of a simpler version, but hopefully this kind of presents the idea too. If you've watched my setup series, then you also would have seen a lot of this. What this is doing is using Excel to filter through around 4,000, 5,000 tickers of day one gappers. Now, it is filtering using the yellow boxes above, so we can see a 50% gap, $2 low price, and then it's giving me the median statistics for those different data points. Now, the reason we use median is because those do not overfit for outliers compared to averages. How an average is worked out is we are adding up all the different samples or tickets, for example, and then dividing it by the amount there is. This will always overfit for larger amounts. So let's say one of those numbers was 500, that's always going to overfit to that extent, whereas the median is just the middle number of that particular range. And that gives us a way better realistic expectation for looking at statistics for trading data. Now, you could see here, open to hive day, which is hive day percentage. We have 15, which is the median. So that gives me an idea of the average open to hive day. And then we also have below that have the standard deviation. We want to know the volatility of that particular data point. So the standard deviation gives us that. And we can also use that as upper and lower limits based on the context of that data point. Obviously, that's a bit more complex and it kind of depends on what ones you're looking at, but it can be a very good resource. Now, lastly is this bonus. This is about applying data from your actual backtest. Now, there's 3 types I mainly focus on. However, there are a lot of types to apply data. So I will be trying to cover each one, but we'll kind of be going over each one quite quickly. So first is median percentages. So a lot of traders, especially if they're becoming systematic, will start looking at averages and medians. Nothing wrong with this. I think this is a great place to start. For example, if we want a short entry, we could use the potential open to high day percentage median as our potential starting to get short on day 1 gappers, for example. However, the key thing most people miss here is median percentages all have opportunity cost. Opportunity cost is simply viewing how many of those tickets actually hit that median percentage and how many did not, to give us a deeper analysis to see if it's advantageous to use that percentage. Now, an example of this could really be done 2 ways. This could be through distribution plots. So we plot out all the percentages plus a favorable metric, such as open to close, to see how those correlate. Or we could do this through P&L simulations, which is what I prefer. So this is where we simulate if all of them hit the median percentage. Let's say not if all of them. Let's say 15% is our median percentage. If all the tickers that hit median percentage, we took a short position on with a 10 or 20% stop, and we're trying to exit at close. How is the profits for that? It could be higher profits and higher drawdown, whereas all the ones that didn't hit that median percentage had lower profits and lower drawdown. Then this can allow us to choose based on our optimization goal to understand what one is more preferable for our trading. 2 is time-based. So a lot of probabilities are not stagnant. They will change throughout the day, especially in small gaps. Now, I got to shout out Day Trading Zoo here. He does some great analysis on time probability statistics. I have expanded upon it, and I know he's done some great other ones that I don't think he's shared to the public yet, but he is just a monster with these as well. Now, a very easy one is if a new high of day is made at 11 o'clock in small caps, you'll have 50-50 odds of a green or red close, whereas in the morning you might have an 80% odds of a close red percentage. This is a lot more beneficial if you're trying to short. Now, this information can be used in a lot of ways. It can be used to help trade manage, filter times to stop trading, or potentially even flip bias if there was a big enough divergence. Now, another way I personally use it is I allow more risk in the morning because I know I have greater odds. So I'll probably have a 20% stop or 15% stop in the morning, whereas later in the day it's going to be decreasing. This won't just be incremental decreases. This will be based on confirmation events, such as it reclaiming VWAP, breaking a pivot high, those kind of things, which I have calculated the odds of and how that affects my particular setups. And those are things I definitely recommend looking into. Lastly is custom. So custom data points are really just understanding the odds of a certain event. So this could be EMAs for exits, volume forecasting for filtration of tickers, or an extension from an EMA as a potential entry point. Now, an extension from an EMA has historically been used as a mean reversion tool for long and short. And this has been on mainly, I would say, swing strategies, but you can do intraday as well. A very easy example is if we were going to look at parabolic patterns, we would calculate the percentage deviation from the EMA to the high of day over the last 5 years. Then you'd find the median of those percentages to determine the optimal value for establishing an entry point. Now, this could be then broken down into sub-buckets based on key variables, and I would recommend going into that. If you want to learn more about backtesting, feel free to sign up for a backtesting bootcamp that I'm running soon. At the moment, it's fully booked, but I may be running one in the future, but keep in tune with just by following my Twitter. Thank you for watching, and I hope you found this valuable.